In this video, we're going to do a question and answer with Jason King. We're going to cover all kinds of hot topics that you want to hear about when it comes to financing your oceanfront condo. And he's going to take you to school on his 15% down oceanfront condo loan. Let's get after it now. Guys, so again, I've got Jason King here. We're going to do rapid fire questions. I'm going to throw out some broad categories and Jason is going to say what comes to his mind.
All right.
Loan, sounds like fun, right? Loan products and options.
Yeah, loan products, of course, right now we're talking about the 15% down condotel, non-warrantable products. Yeah, pretty much 10% down less than everybody else. We're writing it, doing it all in-house, so we're not sending it off to a broker. We don't lose control. Like you said, I'm always here available, me and my team.
Yep. All right, down payment requirements.
15% down minimum.
Yep.
It's also a make sense type of loan. Maybe you're not a maybe you are a first time investor, or your credit is just skirting the edge or something. I'm sure that there can be some arrangements made for exceptions. Hey, if this person puts another 5% down, we'll get them in where you wouldn't qualify anywhere else.
Okay. And then any other kind of requirements like?
No. As of now, I'm still rough as far as all the guidelines go, but 700 plus credit,
yeah,
15% down, making sure your debt to income.
Bank statements, can they use bank statements to get qualified?
Good thing is no, because we have the DSCR loan, which protects the customer and us, because we want to make sure that rent analysis that the appraiser does comes in to be able to match the new payment.
Come on. And so kind of walk me through how they calculate that.
They calculate it through...
Like, do they take off a percentage of that rent from the...
Yeah, so they'll calculate it from me asking the realtor, hey, are there other comps in there that have rental history? We'll use that.
Yep.
There's a great website called Air DNA.
Yep.
Which
sure.
will show you how much they think it can rent out for based on, the market in the area. So there's a bunch of different tools with the new technology nowadays.
Does it create it kind of wash it off for the investor?
It is you 15% down for them is enough skin in the game for them to go, hey, if our analysis of this property is what we call a 1-to-1 ratio, meaning your principal, interest, taxes, and insurance, the rent analysis comes in at that or better, they feel comfortable lending you the money.
Oh, I like this.
Right.
All right, interest rates. First thing comes to mind.
7.5.
Is that for this 15% down program?
It is, yeah.
Yep, sweet. All right.
Which isn't bad nowadays in the world.
No, it's not bad at all, especially for an investment loan. Yeah. Loan approval criteria.
We kind of already talked about that. Credit, down payment. If you got the money and you got the credit, we're going to give you the money.
Doesn't matter if they're self-employed. Doesn't matter if they've got the credit, and they've got the down payment. They don't got to show bank statements. They don't got to.
Correct.
They don't got to jump through all the hoops.
They don't.
Too easy. Property-specific considerations. Are there any restrictions on the type or location of properties that can be financed?
No restrictions. In the non-warrantable, pretty much any condo complex, we're talking about condos, falls into that.
Yep.
Of course, their insurance has to be on the up and up in case there's a storm
No
or
doubt.
something happens. And there can't be any crazy litigation going on in there.
All right, litigation would look like what? The HOA board is
suing. The biggest thing is structural integrity of the building. We want to make sure that there's no lawsuits between the building and the builder.
All right, I got to ask you a question about this. I had a client ask me yesterday, first time anybody ever asked me this. He said to me, he's like, so what's the guarantee that your oceanfront condos aren't going to fall over like Florida's oceanfront condos?
Yeah.
All right, he didn't use those exact words, but that's kind of the gist of it in my jest.
And that's the reason why ever since Florida, the insurance companies and everyone has tightened up their restrictions.
Yeah.
So the powers to be, they're lending this money. They want to make sure that everything is good, that there's no engineer reports that are looking bad over the last few years on these properties.
Yeah. So you guys are checking that stuff out.
Oh yeah.
Sweet. All right, loan to value ratio, LTV. What's the first thing that comes to mind?
85.
85-15, baby. 85-15.
That's right. Less money out of your pocket.
Can I finance the closing cost within the LTV?
That is something that our wonderful realtor partners can do.
Come on.
On an investment property, 2% is the max amount of credit that can be given.
So basically, we can ask for 2% of the purchase price to be allotted in closing credits, so that way you're not coming out of pocket with all the closing costs.
Correct.
Yeah.
Whether it's adding 2% to the price if they don't want to come down, or they're just giving it. You know, that's where our negotiation.
We can get creative. That's a very good point. Let's say you're buying a property and you came in at, $415,000. They agree at 420. Well, you can say, well, listen, let's just do 422 or 423, whatever 2% of that purchase price is, and you're paying more than you wanted to pay for it, but really it's all going towards your closing costs.
Yeah. Basically, it's the way to finance closing costs into the loan.
I like where his head is, and it works to get deals done. Yes. All right, mortgage insurance.
General rule of thumb is, we all know that, hey, putting 20% down will avoid mortgage insurance.
Yep.
Luckily for us, even at 15% down, there is no mortgage insurance on this.
Yes. Cash flow and investment return. How will financing affect the cash flow and overall return on investment, the ROI? Well, guys, whenever you add principal and interest in, it's going to eat a huge chunk of that profit. If the bank's going to loan you money, they're going to want a piece of the action.
Right.
That's just how it works.
Yeah. Less money down, payment's going to be a little bit higher. You're going to make less money, but it's all.
Yep. You put more money down, you got more skin in the game.
That's right.
You're going to make more of the profit on the back end of the deal. I mean, you're using somebody else's money. Are there tools or resources available to help estimate cash flow and ROI with different financing options? There's most likely tools out there. Yeah. I mean, I'm going to provide you a spreadsheet that's going to have a list of your breakdown of expenses.
Yeah. On my side, on my mobile app or online, I have a mortgage calculator. So you can throw in the address or the purchase price, how much you're putting down, and it'll let you know your monthly payment.
Tax implications.
Yeah, tax implications is, we kind of mentioned that. If you're an investor that's going to be, per se, buying investment properties and selling them every few years, that 1031 exchange to where the like properties, you're definitely going to want to.
Definitely want
avoid tax implications.
So basically, 1031 like kind, you can purchase another property that's similar, and very simply transfer over, basically upon the sale of your property, all of that. You can defer the taxes that you would have had to pay
on the equity of selling the property. Basically.
Thank you, Jason, for making it simple and easy.
Yep.
Now, just another quick caveat. Basically, there are personal property taxes that you have to pay on furnishings inside of a unit. Those are kind of marginal. I do mention them from time to time when I go over spreadsheet numbers, on the channel. But you will have some personal property taxes for your oceanfront condo unit. It is a business, and you are taxed on that personal property. Have you gotten hit with anything yet?
I have not.
Yeah, gotcha. Good. Exit strategies.
Yeah, that's when you say exit strategy.
Are we talking? Okay, so what are my options if I need to refinance or sell the property in the future?
Yeah.
Also, are there prepayment penalties?
Yeah, so no prepayment penalties. Again, kind of piggybacking off the tax implications. If you own the property less than 12 months, there's going to be some short-term capital gains versus long-term capital gains on those properties.
Yep.
Depending on how you do it, not being a licensed CPA, I don't want to give too much tax information, but your exit strategy. If you just are done with it and don't want the hassle and want to make a few bucks and sell it next year, do it. There's no implication of refinancing. There's no prepayment penalties.
Too easy.
It's yours.
All right, loan servicing and transfers. How does loan servicing affect payment schedules or loan terms?
Yeah, so we're going to do 30-year financing off of this. Like I said, we finance this in-house.
Yep.
So we're going to be the servicer, the buyer, the seller. We're going to be everything throughout your process of owning. Reserves
and contingencies. How much should I set aside for contingencies such as maintenance or vacancies?
Yeah, even for getting the loan, I'm glad you brought this up. 6 months reserves is always going to be your rule of thumb and what the investor wants to see. They do not want you to put 15% down and you have no money left in the bank account.
Because what if something goes wrong?
Kind of a protection thing.
It's not, you have to look at the bank as a partner.
Yeah, exactly.
And essentially, your investor is coming alongside of you, and he's going, I'll give you this money, but you got to have your affairs in order.
Exactly.
And he's partnering with you in purchasing this condo.
I would hope that that putting 10% down less than everybody else, hopefully you're going to have reserves sitting in the bank.
Should be much easier. It's a much easier target to hit.
Yeah,
Yeah,
exactly.
yeah.
And as far as contingencies go, you're protected up front. You know, appraisal contingencies.
Oh yeah.
You know, finance contingencies, appraisal contingencies, inspection contingencies.
We're gonna do all that stuff with you. Yep. Timeline and process.
We like at least 30 days. 45 is kind of ideal.
No doubt.
Dealing with the HOAs and the insurance companies, gathering all of that extra information.
Trying to get a hold of the people at the HOA to give you the documents.
Exactly. Whether it's a small little mom and pop place that might not have everything, or a lot of these bigger companies send this to a third party. So it's just a time frame of waiting on questionnaires, condo docs, all that good stuff.
Conventional mortgages. Can you do a conventional mortgage on an oceanfront condo?
Cannot. If it, again, the
adjustable
like
rate?
Hotel,
adjustable rate?
No, if it looks like a hotel,
they won't do
operates like a hotel, and you're renting it out, they're not going to finance it.
So if I walk into the place and there is no front desk, and it doesn't have resort in the name, but it's got a pool and a lazy river, does that count as a conventional loan condo?
We would definitely have to look at it. There's 100 other pieces to the puzzle to go into it.
Investor concentration?
Investor concentration.
And for that,
space owned by the complex inside the property.
Yep. So if they do own commercial space inside the property, then it would be an oceanfront condo.
It would be an oceanfront condo.
Yeah, it would be oceanfront
or
condo.
Investor saturation if it's one person owns too many, or the HOA owns a certain amount, or 200 units and 150 of them are investors. You know, and you're over that. So there's a lot of things that go into it.
Okay. Portfolio loans. What's a portfolio loan?
Basically, what we're doing with this product, we've partnered up with another company per se to hold us a portfolio product that I guess it kind of goes with the area. Hey, if I'm requesting that I need this oceanfront condo product, they're gonna reach out, put this product together, and we're gonna hold it in-house, service it.
So basically, it's a specialized program for a special type of property.
Correct.
Yeah. In simple terms.
Yeah.
Simple terms. Okay, so what's a hard money loan?
Hard money loan is most of the time private investors. As long as if you're willing to buy a house, maybe your credit's not that good. Maybe you write too much off of your business and you keep it mattress money under the bed. You're gonna usually pay a high interest rate.
Yep.
You're gonna be able to get the house. There probably is gonna be a prepayment penalty.
Okay.
And you're gonna have a large amount of money to put down.
In other words, you'd rather do Jason's 15% down program
right.
on oceanfront
Most likely
condos.
you're signing the paperwork with the other person to where if you default, guess who gets the property?
They do.
That hard money lender.
Yeah, exactly. So, all right, private money loans, non-institutional financing. What is it? Talk to me about it.
Very similar to the hard money loan. Those are your guys that are definitely non-conforming. Maybe it's just a guy who has a bunch of money. Him and his partners sit in the bank, and they want to do like anybody. You got to have some skin in the game as a borrower, and they're going to definitely make a few bucks off of that.
And they're going to have a higher interest rate, right?
Oh, definitely a high interest rate, probably some crazy fee up front. They're going to have most likely more skin in the game than you are.
Yeah, and your 15% down oceanfront condo program is going to crush it, right?
It is.
All right, home equity line of credit.
Yeah, so generally it's on your primary residence. Say you have a bunch of money in equity. Now, home equity lines are variable rates, so they could go up, they could go down. I myself like a fixed rate. I want to know what my payment is every single month.
And your 15% down oceanfront condo loan is fixed rate, correct?
Correct. Yes, it is.
So I understand that a lot of people want to do a home equity line of credit and buy a property. However, you could go apply for a loan with Jason, and you don't have to worry about a variable rate. It's going to jump on you and change.
Yeah. Use your home equity line for other things. Maybe you have a bunch of credit card debt. Maybe you want to put a pool in your house, or remodel the investment property, or remodel home, or just have a backup plan. If your
That's a good point.
kids go to college, I want to help pay.
Because it's a smaller amount.
It's a smaller amount. you have a home equity line wrapped up in all these investment properties and one goes down, I would hate to see your primary go down in flames with it as well too.
Do you hear that? He's giving, this is a lender telling you don't do that.
Right.
You should use this 15% down oceanfront condo project.
Exactly.
And now the remodel thing that's pretty nifty. I didn't think about that.
Yeah.
They could do a home equity line of credit on a low cost remodel right here in our market
Exactly.
for their oceanfront condo home equity. Now, should they take that loan out before they do a loan with you or after?
It doesn't really matter in all honesty.
Really?
Maybe
because with your program, there's no docs.
You're right. Exactly. There's not.
Yeah, that's good. I like it. Sweet. Okay, so seller financing. Why? First thing that comes to your mind, and then tell me why they should do your 15% down program as opposed to seller financing.
Yeah, seller financing. I mean, of course, you guys are going to have to come up with your own terms and conditions as far as seller financing.
No doubt. It's probably going to be in the high 7s.
You're right. It's probably going to be less attractive than. It's just like selling my home for sale by owner or having a realtor. I'd rather have a professional there to walk me through.
There's no question, man. Like when people are serious about buying or selling something, they're going to go get a broker. Yeah. They're going to go get an agent, like somebody that knows what they're doing. That closes a lot of these transactions because they're serious about doing it for the most part. Yeah. I mean, that's just how it is in my mind. Yeah. I mean, like now, yes, can you a for sale by owner? That person is trying to maximize and get as much money as they can out of the deal. So much so that they don't want to involve, sometimes attorneys. They don't even want to involve attorneys. They don't want to involve. Anyways, the point is that, guys, seller financing, yes, you can do it. You might find some good terms, but when you use the 15% down program, you know what you're getting. You're dealing with somebody that's done lots of these transactions. He's going to bring a wealth of experience and knowledge to the table that is worth having in your corner when you're making an investment. You got to kind of look at this as a network or a team. Like, I'm plugging you into my network. I'm bringing you over to a lender. I'm bringing you over to an inspector. I'm bringing you over to an attorney. I'm bringing you over to a contractor that can remodel it and get it just right. So we're plugging you into a network. You're working with a cross-functional team here, and we're all used to working together. So we're going to bring all that expertise to your deal. And that's what you want.
Yep. Exactly.
And that's what you're not going to get when you get seller financing.
Exactly.
Yeah. Cash out refi.
Yeah. Very similar to a home equity line of credit.
Okay.
I prefer a cash out refi because, again, it's that set number.
Yeah.
It's that set interest rate. It's not variable. HELOCs are great. Like I said, small projects, but if we just want to take out a lump sum of money one time and have a payment on it, definitely cash out refinance.
All right. So question, can people borrow against their IRAs?
Yes, they can.
Should they do that or use your 15% down program?
And maybe if they need a little bit of help, let's look at it. Let's look at the terms and conditions. Maybe it's their current 401k and they're still working. If you're going to be able to pay it back in time before you retire, those types of things. I would say if we're thinking about using investment income IRAs, let's talk to their financial advisor and see what he thinks. Okay.
And then commercial loans, last one.
So we can do commercial loans. We know that if you're looking to buy the whole complex, definitely come to us.
Absolutely. But so let's say somebody's been in business for years. Mm-hmm. They can walk into their bank and say, listen, I want $400,000 line of credit for my business. Should they do that or should they do your 15% down program?
Yeah, so it's definitely one of those things. I always want what's best for the customer. Maybe it's a smaller bank and they're just giving them a line of credit at a great rate just because of their personal relationship and deposit accounts. It may be the best thing, but the 15% down, I mean, it's tough not to take a 15% on my product if you know we can get it close. But let's look at both ways. If I compete with what they're doing, then let's have a little competition and see what's the best rate for you.
Now, Jason's always looking for a good deal. The last minute here, I want to ask you, tell me a little bit about that assumable deal that you ran into that you're kind of considering jumping into.
Yeah, so I actually have a client who has a contract to build a house, but they have to sell their condo that they're living in now currently, and they brought it up to me that we just want somebody to take over our mortgage. So me knowing the game, I had them reach out to their mortgage company, and their mortgage company is getting them back some information on it being assumable, meaning I just take it over with their same wonderful 4.5% interest rate.
That was 4.5%.
And I just take it over with their payment terms, conditions, and then it's mine.
And we're talking about, this is a $200,000
$200,000 condo
condo.
that I'm going to get in for just over 150.
So
Potentially.
the lender that I'm introducing to you does these deals. He's in the market just like you. He's an investor. He's working the game. He's putting the hustle in. He's doing the hard work. He's the kind of guy that you want handling your loan and advising you financially. Guys, you gotta trust me. You made it to the end of the video, but you need to click the video that's on your screen right now to hear how Matt Freeze makes $15,000 to $30,000 a year in annual profit off each of his 8 Myrtle Beach Oceanfront condos. That's over $180,000 in average annual profits right there in passive income each and every year. Click the screen now.